Hey, thanks, Paul. We were flying pretty high through Paul's presentation. My job is to get right down to how we're going to generate the numbers. For example, in Paul's presentation, he noted that transportation efficiency is often a great investment for companies. But it's also important to figure out how good is that investment in your specific company, and how is it relative to other investments in your company. So we'll be working on how you can look at those specific kinds of problems. More particularly, I'll give a quick overview of Climate Earth. A lot of what we do parallels financial accounting. And one of the things I hope that you'll get out of this discussion is the power of the marriage of financial accounting and carbon accounting, or at least maybe we're in the betrothal stage at this point in the world, but certainly I hope you'll walk away with a very good feeling about the power of that merger. We'll be looking at how carbon accounting can be a centerpiece, and in particular play a very strategic role by combining economic and environmental indicators into some key metrics to better manage your business. We'll do that through a case study, and then last of all, we'll look very strategically at how carbon accounting can help manage your risk in profitability and take an assets and liability view of carbon accounting. So once again, Climate Earth, we provide a turnkey system, as Frankie said. It is a software as service model. We cover the entire range of emissions, that is scope 1, 2, and in particular 3, your supply chain and product carbon footprint information. Climate Earth experts perform what we call the mapping and ensure compliance with standards such as WRI, WBCSD, and produce your initial reports along with recommendations for appropriate actions. Effectively, we're a platform to develop, measure, and manage your greenhouse gas reduction strategies across your entire supply chain. And last of all, I'd reiterate once again, in particular by integrating financial reporting process, carbon can become a key metric and an integral part of your management practices. So let's take a look at some of the parallels we see developing between financial accounting and carbon accounting. I think the key thing is that financial accounting has been around for well over 100 years. We have very mature standards with GAAP and FASB, but in fact the WRI standards have been around for over 10 years. So we have a pretty strong basis in standards for carbon accounting. We have a required audit process. It's still optional, but the verification and validation procedures are emerging quickly, especially around as the carbon markets develop. We have periodicity in financial accounting and also an emerging standard in carbon accounting in that most CO2 or carbon footprints are measured over a period of time of 1 year. We have strong investment oversight with the SEC, and certainly cap and trade legislation is probably going to bring both the opportunity of investment and the issues around regulations that we see in investment as that emerges. The basic or the bottom line here is that financial accounting is the language of business, and it looks like it's going to provide a strong baseline for ECA emerging along similar standard lines. I want to back up just for a moment for some of you who may not be familiar with the structure and language of carbon inventory analysis. Essentially, WRI has established 3 areas of emissions, scope 1, 2, and 3. Scope 1 refers to your direct emissions, that is emissions that are produced directly by your company in the manufacturing process typically, or in company-owned vehicles. Scope 2 is the emissions produced by the electricity that you purchase. And Scope 3, which is typically 70 to 90% of a manufacturing company's emissions, covers supply chain and product emissions as well as other indirect emissions such as employee air travel. So with that framework, we developed enterprise carbon accounting process we call ECA. It begins with data extraction, what we call rules mapping, a refinement and iteration process, the generation of analytic reports, and then business actions which result in repeating the cycle. Typically, the initial cycle is around 30 days, so you get very quick results to measure your progress. I should say that there's 3 key attributes to this system. 1, it's periodic. Note that it is something that's designed to create a periodic information base to manage results. 2, it's rules-based, and we'll talk more about that in detail in a few minutes. And 3, it's very data-driven. That is, it's driven by Climate Earth's database developed by our chief scientist, Dr. Su, called CEDA, Comprehensive Environmental Data Archive. CEDA is used by the EU, the EPA, the UK government. It's been widely peer-reviewed over the last 7 to 10 years. It's well respected in the industry. CEDA, however, or a discussion of CEDA in particular, is going to have to wait for another discussion. I just wanted to mention that the underlying data behind the analysis that is accomplished here is based in rich and well-reviewed science. So let's turn to the case study. This was a large manufacturing company which had 3 objectives. 1, they were looking at developing a comprehensive corporate strategy for greenhouse gas reduction. They felt there was some strategic benefit in potentially labeling their products with a carbon label. So that was one of the major objectives. And last, they wanted to beat competition's green claims. Effectively, then, they decided to adopt an enterprise carbon accounting approach to achieve these objectives. And then going back to our model, enterprise carbon accounting begins with a very detailed data extraction and load into our computer systems. Generally, that initial load is the general ledger trial balance of an enterprise. The general ledger is the best indication we have in any enterprise, or the best measure of every single action that a company takes. So it ensures, if we carbon footprint every line item in a general ledger, we have a pretty good idea that we have a complete carbon footprint of the enterprise. So that's number 1. And number 2, it drives a methodology which essentially is based on breaking your enterprise into 1,000 or more little parts and carbon footprinting each one of them. Let's talk about the rules process that we use to apply the general ledger. For example, looking at Scope 1, we pull out the Scope 1 general ledger line items. Typically, those dollars are then converted to, for example, in propane, the number of gallons used, and then that is mapped to the CEDA database, which I mentioned earlier, which gives you a carbon footprint of your propane use. And in the process, you can note this establishes a rule that converts the CO2 or CO2 equivalent to the dollars spent on that line so that we have a repeatable metric. If we look at Scope 2, a similar process is typically followed, though we pull down the utility bill, convert to kilowatt hours, and then map back again to the CEDA database. Scope 3 can get a little bit more complex. For example, the general ledger may only provide us with a cost of goods sold. So we may have to pull out a materials backcast or detailed bill of materials from your manufacturing system to look at specific commodities coming into the organization. We then may have to look beyond the commodities to specific levels. For example, steel is not always steel. We have sheet metal, we have forged steel, we have, in this case, 3.5-inch steel pipe. So we need to understand the specific detail, especially if the line item is material, and then in turn map that to the CEDA database to develop and identify the carbon footprint of those commodities.